right, welcome to the 2023 kickoff webinar. We've got a lot to talk about today, and so I planned that out. Got lots of slides. We're going to take questions. So let's get right to it. Here is just a brief outline of what our agenda is going to look like today. We're going to talk about trends. We're going to talk about markets, and we're going to talk about predictions. And then we're going to wrap it all up with sort of what my recommendations are of where you go from here to grow your syndication business and expand from that. So let's begin with a general overview. Oh, and first, a couple of housekeeping tips. There's a Q&A box down below, and so feel free to put questions there. I may or may not be doing them as they come in. It's sort of more a matter of if I have a good answer, and if it fits in with what we're talking about, then we'll talk about it. If it doesn't, we'll answer it at the end of this webinar. Secondly, there will be a recording of this call. That's a common question. We'll probably put it on YouTube so that you can see what so you can watch it there. All right, so let's go ahead and get started. So 2022 was quite a year. So these are trends that certainly have been talked about in the industry overall, but these are also some trends that I see as a syndication attorney and things that have come up. But it also comes from my view as not only a real estate investor and a real estate syndicator, but also just generally being an investor and heavily involved in finance. And so these are sort of my view of what's going on, and your mileage may vary. So first, in my business, we've seen probably the biggest uptick from syndicators who've been putting together short-term rental packages. So that's your Airbnbs. So planning out what a investment would look like for investors focusing on short-term rentals. What's interesting about the short-term rental market is there's not a huge amount of data in it. So one of the biggest is DNA, which puts out data on that industry. But it's at this crossroads where it's a battle still between your traditional hospitality industry and Airbnbs about whether, who's going to have that dominance. So your hotel industry, the typical traditional hospitality industry, is very focused and driven by performance in the overall jobs market. So a huge percentage of that market as a whole, of all of that industry, comes from, is there sufficient jobs to support it? So people traveling for business. I would suspect that's been greatly eroded because of COVID and people getting more used to communicating on Zoom, meetings like this rather than in person. But then on top of that, then you have the erosion away from the people going to stay at hotels and instead going to Airbnbs. I know my wife and I were just talking about 10 minutes ago about this summer and what we're going to do, and we'll probably spend a couple weeks by the beach, and we're really looking at Airbnb rather than the typical resort that we go to that's nearby. So short-term rentals has been a major influx. I've gotten a number of clients that are putting together these types of packages, and so that's been very significant. Another very, very large component of my business that I see other people doing is development. So we have a lot of developers as clients, and I've noticed a shift, and I don't really have any data to support this other than new housing starts are down, where I haven't seen a decrease in the amount of development activity itself. What I have seen is a shift towards the earlier phase of the cycle. So where before I would see a lot more, okay, we've already done all of our horizontal development, got all our entitlements in place, and now we're going to be doing the actual ground up construction. I have a lot more clients of recent, so probably starting in about maybe June or April or May or somewhere in there. There's been this shift towards the horizontal development, the land acquisition, horizontal development with the intent to ultimately sell that. May not be actually what's going on, but it looks like the shift away from new housing starts might be indicating that as well. This is true. We haven't actually had a huge influx of housing starts for a while, for maybe 4 or 5 years as it is, but now I'm seeing more of it, at least in my business, a trend away from that. A huge component of my business before, especially last year and going into the very beginning of this year, was on crypto type offers. Obviously, there's some complications with crypto offers, being that we have restrictions on transferability, so the tokenizing was always an issue. But we had a number of clients that were putting together hedge funds, putting together private equity raises, or putting together novel businesses that were using some sort of crypto as part of the mechanism, be it for voting or for something other than the actual tokenization of the asset itself. That's completely gone. I haven't had a client in the crypto space since maybe June or July, except for maybe a couple that were doing businesses related to it. But it is very dried up. So I think an overall trend is we're seeing the crypto space isn't nearly as attractive. Before, I was getting people putting together mines or these hedge funds I talked about, something like that. We were doing a lot of deals in that space, and now we're not doing any. So we've certainly seen a shift away from that asset class completely. Overall, in the overall stock market, of course, we are seeing a rather challenged stock market. And this is part of what I want you to take away and to think about as it relates to what you're going to communicate to investors going forward in order to convince them that this is a good opportunity to sign up. So, with the overall market being hammered this way, we're seeing a shift in how money is spent. So, we've got where we had this massive increases in the market, where it was harder to make the appeal to the sensibilities of the investor that, hey, you should come invest with me. I'm private. We're going to get you these additional returns. We have this little bit of alpha here that we're able to take off because of our value that we're adding. But now, with the market just being very deteriorated in general, there's still this amount of cash that has to be placed. So it's not expected in the next year that income levels are really going to drop. And it's not expected that overall unemployment is going to rise to the point of where it's going to cause a problem in the overall market, like as a whole. There will probably be some sort of some sort of recession that takes place. But as a whole, I would expect that you're still going to have roughly the same amount of investable money from your investors that they need to place, and they need to place somewhere. Right now, that is not going into the stock market. Right now, it's not going into these kinds of things. It's certainly not going into crypto. I read that one of the funds just lost $6 billion. We're no longer invested with them in the crypto space entirely, and so funds are leaving alternative asset classes and looking for a new place to go, and it's not in your publicly traded stocks, which is something that you have as a way to talk about with your investors. Now, interestingly, we've seen that rents in general, because most of my clients are real estate. So this is going to be a real estate centric talk, but I'm certainly going to highlight about as many points along the way that apply generally, but it's probably about 80% of my clients are in real estate, either as developers or doing really in every asset class. We have people in multifamily, industrial, office, hospitality, and then some more unique areas as well. So I'm going to talk a lot about that, but the rents also, or real estate in general, affects the whole economy and certainly affects the perception about economy. And so that's why we can focus on that a lot here. Rents hit an inflection point. And so overall, nationally, we hit this point about June where rents started coming down overall. Now, this is rents primarily in the multifamily space because multifamily real estate typically you're talking about 1 year leases or the rents are set at 1 year. So we see movement happening there much quicker than in the other asset classes, other than hospitality or short-term rental, where they move much quicker. So rents started coming down. And we also saw a trend towards vacancy towards normal levels. So vacancy went down toward in the middle of the COVID years because people were no longer being evicted. That's now starting to adjust out, and we're seeing a normalization across where we're going to be at, and it's predicted and forecasted to level off back at that rather normal level. So you've got a rent seem to start be coming down, and vacancy seems to be stabilizing back up. So increase in vacancy. And then you've got another pressure that is hitting real estate as well, or at least being talked about, and that is is inflation. So overall, inflation has been, it's certainly been on the news. It's certainly being talked about. The Fed is combating inflation, and we've certainly seen numbers that seem to indicate that inflation is very high. I know that certainly a lot of expenses that we pay regularly seem to be a lot higher. And so inflation definitely seems like something that's present as it's been so chronically low for so long. Now that may be, oops, sorry about that. That might be because of being held down by loan rates or something like that. But you would think that with an increase in money supply, that you would have a much greater amount of inflation that would have taken place earlier. So your mileage may vary. And actually, we'll get to that in just a second. So we have, and now I'm going to switch back to market rent, and you'll see why in a second. So market rents per unit seems to be going up. Now, I know I said earlier that it seems like that overall the rent has hit that inflection point, and it doesn't really reflect in this chart. This is rents for 8 specific regions that I've been tracking for the past year. And sort of where rents are at. You can see slight downward turn, but not anything gross. But you see overall a trend over the past few years and the forecasted amount of rents going up. Now, interestingly, though, getting back to the idea of inflation, is once we adjust for inflation, that picture changes entirely. We suddenly get to this very, very, very flat landscape where we had this major pop in the amount of rents per unit during COVID and in the past couple of years. But now that's starting to come back down again to that normalized level that's inflation adjusted. So inflation as well also seems to be moderating. It seems to be coming down. And this just came out today. CoStar sent it out from the Bureau of Labor Statistics. An interesting argument that now the core price index seems to be really at historical norms, not anything unusual. So, which is going to ease back pressure on the Fed, maybe making money more available, but certainly that a lot of that pressure has to do with recession and what's going to happen as a result of that. So when we talk about interest rates, this is what most people think of. This is just the 3-month yield. And right now we've had a very, very chronically low period. of time, and then the massive buildup that's built up over the past few months. And you've certainly felt this too. So you hear about mortgage rates. If you've shot mortgage rates, you've seen it going from sky high, from even below 3% now to well over 6% for a regular home loan. Now we have the approximately, huge interest rates going on. And so it would seem like that's going to create a pressure on real estate itself and drive cap rates up. Remember, cap rates and overall prices are opposite of each other. So when prices go up, cap rates fall, and vice versa. And so you would think that as interest rates go up, then cap rates also are going to go up, thus driving down the yields on the real estate. But that's not actually what real estate tends to follow. So real estate itself tends to not follow the 3-month, like what the Fed is. I mean, the 3-month is an easier depiction of what the Fed is doing, but the 10-year yield is much closer. And you see that, yes, it's gone up, but it hasn't gone up so substantially over the past few years. We had very good markets in 2019 and 2020, and certainly had a low point, had some very, very low interest rates in all through 2020 and 2021. But now we're starting to see that creep back up to a very kind of normal level, which translates probably to regular normal cap rates. So nothing too compressed, but just a normal level. So that's my general depiction of what I see as overall like market trends that are taking place. In general, we've also got we've seen as investors have started coming and being more and more attracted to different offerings that people putting together Reg D offerings are doing. We're seeing in general a slight creep up in terms of the amount of fees that are being charged. People are more willing to charge fees that are at the higher end of the spectrum than the lower end of the spectrum, and we see a slight push on the different levers that change the overall IRR and the amount of money that syndicators make as well. I think that's likely to continue. I think that syndicators will be able to make more money. And I think that some of these pressures, while it's not going to overall change real estate or any businesses fundamentally, what it will do is it will increase the inventory supply of people in specific situations who suddenly need to make changes to what they're investing in and how they're doing it. So with that, let's change gears and start talking about individual markets. Now, let me take a drink. So last year, I put out a notice to all my people when I was coaching how to do syndication of the 8 markets that I was watching, and I thought we should continue that tradition, even though I no longer coach full time anymore. I still have a few people that I mentor through this process. And of course, my clients are always in the law world, are always more than welcome to ask me as well. But I put out a note of the 8 markets that I thought were going to be hot. So I thought it would be useful for us in this call to look at those 8 markets and see how I did in general. Overall, it's one of those markets where it was kind of hard not to do pretty well. But I think the markets that I chose did very well, and I think there's very few surprises. There are a few places that have dropped off my list and will go off of my list for next year as well, for 2023 of the markets that I'm watching more closely than others. So let's go back to slides. Overall, Raleigh, North Carolina. So this is obviously I chose to move my family here, and one of the main reasons is because of the market. Raleigh has three major universities. I believe they're all top 50 universities, and it is a incredibly fast growing place. It's the number two growth in the country right now. It takes place in the Raleigh Durham area. And it is you have a major influx. So you have Apple built a new facility here while it's still in construction. Then there is a Facebook is building a new platform here. A lot of new companies and existing companies with very, very widespread are coming to the Raleigh Durham area. I think that trend is long term. Now, one thing to note, there's been talk about I know Redfin put out a survey maybe a week ago about their predictions of overall which markets they think are likely to be more to undergo a recession back to mean levels. One thing that their model didn't take into account, and I wish I had posted something about this here. One thing their model didn't take into account was the other economic forces that cause real estate to overperform. So it's all well and good to say, well, Raleigh's had extensive growth over the past few years, and that growth is likely to be curtailed because it's grown so rapidly, and so that's more likely to see a contraction, in this up and down phase of the cycle. But what they didn't take into account is the other factors that really drive growth. So when we're talking about growth on the residential side or the multifamily side, the main key indicator is population growth. Population in Raleigh is growing at a very fast rate. In fact, all of the places that I chose, that was a major factor of why I chose them. Raleigh is the second fastest growing metropolitan area. And so we would expect Raleigh to have that. At the same time, we have a new influx of new jobs, higher paying jobs, and we still have built around that the community of these three major universities, all supporting a educated workforce, which should keep income levels high. Now, that should support an overall real estate market and not see a lot of suppression in prices on real estate in general. So my prediction is Raleigh still will be a good market. And it looks like over the last 12 months, I was pretty right. So we've got a major decrease in vacancy. We've got we've had a slowing in rent growth and rent per square foot, but that is and sort of going back to the mean, but nothing like nothing very substantial that would cause too much of a concern. Market sales price per square foot has been continuing to climb, and the cap rates are generally slowly tapering off. In fact, it looks like just slightly coming up, barely. Sales volume has been consistently high. Raleigh seems to have been a good market, a good pick for me. And I'm doing these kind of in an order, not necessarily of the best markets of the 8 that I chose, but also the good ones versus the ones that I was kind of surprised about and have fallen off the list. Atlanta has also been a great market. We actually have a lot of clients from Atlanta doing a lot of different projects there. And Atlanta just is going to continue to be a great market. Overall, their vacancy has continued to go down. We've seen their rent growth climb. Maybe it's stabilizing more, but certainly sales prices are going high. Market cap rates are high. Sales numbers are high. Columbus, Ohio has actually fallen off my list, but it's fallen off my list because I'm kind of concerned about overall vacancy. We saw this weird uptick on vacancy, and that might have just been because of the leaving of a large employer. I'm not exactly sure, but Columbus has always been a good market, and now it's just looks like maybe it's time for that. It might have peaked. So, but Columbus was also a good pick by me. Charlotte, North Carolina. You'd think it's different than Raleigh. It's about 2 hours away, so they're different metropolitan service areas. We've seen a nice, very strong market there, where Raleigh has a lot of employment in the tech sector, in bio and pharmaceuticals, things like that. Charlotte is almost exclusively banking. I wouldn't predict that. I would believe that Raleigh is a little bit more stable because it has a more diversity of income levels than what Charlotte has, Charlotte being so heavy in banking. Phoenix was also a good market, but what we've seen is a general trend um, that I think Phoenix might have capped out. So you'll see it's fallen off my list. But Phoenix has overly been a good market. It certainly had extensive growth. Little history, I actually grew up in Phoenix or in Scottsdale, so I know the market pretty well. But I would predict that there are nicer places to live for less money than Phoenix and Scottsdale. Nothing negative to my Phoenix and Scottsdale clients. I used to live there, so I guess I can say that. Denver, Colorado. Denver's been an amazing market. I think, though, Denver might be starting to slow down a little bit ahead of time. Studies by IRR IRR is a major appraiser of real estate, and they compile data and put out reports. Their mid-annual started to show Denver was a little bit past a hypersupply, starting to approach recessionary periods, and I think it's slowing down. It was a good pick. Oops, it was a good pick last year. I don't think it's going to be a good pick for 2023 in general. I mean, everything. There's always a great deal in every market. So, Seattle was a phenomenal market, but my prediction is too that this is going to be slowed down a little bit. Houston has always been a good market, and it will probably continue to be a good market. It's not what I'm going to be tracking the next year, even though it's good. I think we've just had it's grown so fast, and it's been such a huge influx of development activity. I would expect that it's kind of gotten a little bit hyper supplied, so I would expect it to slow down. So my predictions on markets that I'm watching right now, we've got two newcomers and three mainstays, Raleigh, Atlanta, and Charleston. Oh, four new ones. Wow, nice. Oh no, three new ones. There we go. Raleigh and Atlanta stay on the list. And coming onto the list is Charleston, South Carolina, Indianapolis, Indiana, and Nashville, Tennessee. Now these are all the MSAs. I think those are all very good markets. And again, it's not to say that any other market is not amazing. Yeah, certainly Florida's got a lot going on, and it's got a lot going for it. Texas has an enormous amount going on. These are the markets that I think have the hottest opportunity for 2023. And in December of next year, we can look and see how I did. So let's talk about my predictions about the sectors overall. I broke this down into really kind of where most of my clients come from. So you'll see kind of a wide range of things. I also do have a fair number of business clients as well. I didn't break it down there because there are so many different fields that they come from uh, from pharmaceuticals, medical devices to stone, all sorts of different things. So we've got at the top of my prediction this year is affordable housing. As we enter into a recessionary period, affordable housing is going to do stellar. I have no reservations about saying that. Affordable housing is where it is going to be in 2023. There is going to be a lot of money that can get made um, in that area. We have a lot of clients already in this space. They're going to keep doing really great, and I see just very bright things for affordable housing. Medical office should do good as well. Medical is a nice stable asset that generally does very well, especially in a recessionary time, because it can continue to do well. People still need to go to the doctor, still need to go to the dentist. They just and they can put off some of those other spending. Industrial, like my prediction as we continue through the supply chain issues, I think that answer is going to be answered by real estate and industrial technologies. And so we should continue to see a good growth in that sector. Short-term rental is going to probably continue to be good, especially as people still continue to shift away from hotels into short-term rentals, which is a little bit more personalized, a little bit more lifestyle-y, and I think that's a general trend for what people are doing. I think multifamily is going to stay fairly strong, certainly more in the affordable multifamily space. So your Class C multifamily is going to do well. Your Class A, I'm not sure how it's gonna do. A lot depends on if rates come down substantially by mid next year, which is what it looks like is going to happen. If we see rates fall, more likely people are going to decide, okay, it's now time for us to move out of the Class A multifamily space into housing while housing prices are down in some areas of the country. Um, Small retail should continue to do well, but still watch it. Hedge funds can either do really well or they cannot do really well. Really depends on their strategy, whether or not they're going to be able to make that difference out of what the market is doing in general. Single family homes outside of the affordable space, I'm a little bit more hesitant on, mostly driven by rates. That's a heavy impact for people. Your middle class family who's going to be buying a single family residence, the amount of interest that they're going to be paying as part of their loan is very important. And with costs still being high on materials, it's really compressing that spread for your single family developers. Then we have three areas which I think are not going to do well at all. Normally, I don't do a prediction on this, but again, we're with an asterisk. Every sector also has a great deal in it. So just because it's on this list doesn't mean it's not possible that something is going to knock it out of the park. But I think big retail, office in general, just general office, as office tries to figure out what it's doing, not only with not expanding new jobs very much with a recession coming, but also with trying to figure out who's coming back to the workplace and who's not. And then crypto, I don't see a lot of room for growth in the crypto. There's too many negative pulls on the crypto space, right? All right, so let's go into our core plan. So let me get a little break. So as you think about what happened in 2022, and as you think about where you want your business to go in 2023, it's important to look at what happened and where you want to go. There's always all these pressures going on, and there's markets going on, and there's things going on, and your competitors are going on, and then you have investors who have their own needs, and everybody has their own needs. And so I thought it would help to kind of talk about how I would approach or how I'm approaching my syndication business, how I'm approaching my law business, but this will kind of not be in the same context as would be useful for you. but how I'm approaching certainly my syndication business and what the things I'm thinking. As an overall frame, I like to think of things this way, and I cannot take credit for this. I did not come up with this framework for thinking about planning. It's entirely from other people. So big asterisk. This is not my own, but I think it's so incredibly powerful that it's very useful. So right now we have you, and we have you in 2022, the end of December. So right now you are here on Earth, December 2022, and you're thinking about where it is that you want to go. And your business has been whatever it's been, but ultimately you want it here. I'm going to draw a bigger smile because you want even more. This is December 2023. So right now you've got things where it is, and you've got this idea, this forecast in your mind of this future self that you want to become. And somehow you have to bridge this gap between the two. And I posit that you actually have this area here that is worse, right? So you have this possibility that exists here that's worse than it is, that's worse than you're at right now. Because if you don't do anything, certainly things are going to get worse and not get better. But that's not where you want to be, and that's not why you're here. And so that's not at all useful. So somehow you have to bridge this gap and come up between 2023. Now, coming up with year-long resolutions doesn't really work. You've got this great idea and everything works out great from January. And then suddenly February comes and it's a little bit slower. And then comes March and it's a little bit, something else happens. And then by the end of March, and when you're into April, suddenly you've forgotten everything. I don't know if you've read this great book, Traction. Uh, but it talks about that as well. And then also another book that talks about the same idea is 12-week year. That breaks down everything. 12-week year breaks things down into month-long cycles and setting monthly goals. Traction breaks it down into quarters. I think quarters is a little bit more useful. So somehow we need to come up with how to get at these different levels. And the best way I know to do that, that's not really the best way, is by breaking things down into quarters. So Q1, Q2, Q3, Q4. So the steps that I'm going to talk about are to start by thinking about where you're at today, December 2022. If you don't know where you are on the map, it's impossible to get to where you want to be in December 2023. So you start with the present. And then you start forecasting where you want to be in 2023. Ideal. And then you can come back, and we don't need to know where you're going to, what you need to do in Q4 of 2023 at this point, because you're not there. You don't have anything set up for it. And you don't need to set up anything for Q3 in 2023. And you don't need to set up anything in Q2 yet for 2023. All you need to be concerned about is what you're going to do for the next 3 months in order to get you a little bit further to that goal in 2023. So that can now look for 2022. like this. So once we identify that we're right here in Q4 2022, and we start identifying, okay, what needs to happen in to get to this point in 2023? What needs to be true about me at the end of Q1 2023 in order to get to that point? So right now we're talking about right here. What needs to be true in order to get up to that point? And it's useful to start thinking about things in frameworks and about breaking it down. So we're going to go through just some of what I used as for coaching in order to do that. So we have the core. And so the core is specifically for a syndication business, private equity funds. This is my work product, so this I will take credit for. And it starts with the company, and then it goes to operations, and then to your rally, and then to your exit. And then you're circling around in within operations, rally, exit, and always checking in with company to make sure that everything is aligned. So when we're talking about, so let's talk about what each of these means and what we're talking about here. So company, we broke it down to a simpler framework by giving some alliteration. So company is made up of foundation, founder investment theory, flight crew, and frameworks. So foundation can be thought of mission and your values. Everything needs to be lined up to those, right? So your syndication business, you as a whole, needs to be aligned to what it is that you want to do. So really all of my clients are looking to do great things for themselves, but also for their investors. They want to make a positive impact on their investors' lives, make them money, and make themselves money at the same time. I don't have a single investor or I don't have a single syndicator who I work with who I don't believe has that value. They all do, and I would guess that you do too. And so it's not when we say values. I mean, obviously, it's not cheating anybody. That's not a good value to have. But also take a look at the book Traction. It really talks about how to use this and how to do it better, if that's helpful for you. But ultimately, you should have some sort of idea or feeling about what it is that your syndication company does. Underneath that is something that I talk about very, very, very regularly. It's part of our work product here, and is part of, we've actually went and trademarked it. We believe in it so much. And that's the founder's investment theory. This is the asset class, the location, the risk tolerance. It's the whole framework of how you talk to your investors so that your investors, when they think about you, they think about this set of themes. Like if you were to say to somebody on the street, Apple, which invests in its own products that it creates, it's got a very specific type of thing that it does. It wants beautiful products that perform in a very clean way, without a lot of buttons, and something that should be relatively intuitive. I'm guessing that's what their general founder investment theory is. For when it comes to real estate, most of the time we're talking about very specific asset classes, be that multifamily or office or not necessarily even those, because for example, I don't have a specific asset class that I do, but I look at very, very specific kinds of risk tolerances. I look at very specific kinds of locations. And so my investors generally know, okay, if I invest with Tilden, this is what we're going to get. We have a lot more material on founder investment theory, and we can go over that in more detail at any point. We also have a video online about it underneath launching syndications on our website. So feel free to check that out if this is at all interesting. Then we have Flight Crew, which is your internal and external teams. So your internal teams is the people within your company that do the work. External teams is people like me. I'm part of your team, but I'm not paid like an internal team member, and I don't have responsibilities to you other than those external responsibilities that we've already agreed that I will do. And then you have frameworks, checklist, optics, checklists, and optics. Now, excuse me. The point of this is within that context, within the idea of building in these steps, is where are you at today in your foundation, in your FIT, which is founder investment theory, your flight crews, and your frameworks. And then where do those things within company need to be? Where do you want them to be as part of your company? For example, in terms of foundation, in terms of FIT, in terms of flight crew, and in terms of framework. And this is just for company. And I would suggest that you write these out. Write them out in terms of your present self, where you're at today, where you want them to be for 2023, and what do you need this person in the end of Q1? Where are they at with company to get them and to propel them to the end of Q4 of 2023? Where are they at in company? Where are they at with FIT? What's true about their FIT? It's probably it's starting to get defined by the end of Q1, I would assume, so that you can talk to investors better and be able to do those things. So that is company. Now, operations. So we come back to operations immediately. Now, in your life cycle, most of our people are currently syndicating, and so they may not be working on a project today, a new syndication, or maybe they are. And if they are just starting a new syndication, then they'll skip right to Raleigh. Otherwise, they're probably in this operation stage. Operations is command, that's your asset management, custody, which is property management, communications, and cultivation. And so in terms of that part of the business, in terms of the operations side of a syndication business, where are you at today? I mean, do you have an asset management plan? Do you know how you do it? Do you do your own property management, or do you contract it out? Have you done a property evaluation to kind of understand where it's at any given point? So that way, when your investors are asking you about, well, what's coming down the pipe, are we going to have any deferred maintenance issues or things like that? You at least know, and you have a plan in order to discuss those things. Do you have a regular schedule of when you communicate with your investors? Because that's going to pay back as you try and convert them later down the road. And we talk about that in the exit as well, and bring them into the next deal. So that's operations. And then Raleigh, this is really the new offering. So this is find, which is find your investors, find the asset you're going to buy. And I put asset here because sometimes they're not, sometimes it's not real estate, sometimes it's a business, or it's some other opportunity. You need to form it. You need to put together the offering documents. That's obviously what we do. You need to finance, or at least think about finance. What's your balance of equity versus debt? Are you taking debt through the syndication process, or are you taking debt externally from regular lenders or hard money lenders? And then fund. How do you latch investors and get them to commit? And then lastly is that exit. So is it time to exit? So exit is represent decision. So is it time to exit? The deal itself. So that's the transaction in order to exit. The distribution, your final distribution, and then deployment to get your investors right back into the next deal, which actually is Raleigh. Is going in opposite. The arrows are backwards. So that is the overall idea of the court. Is it provides a framework for you to come up with your business and then walk through this model of coming up with all those things about where you're at today, where you want to be at the end of Q4 in 2023, and then ultimately where you want to be at in Q1 of 2023. And at the end of Q1 2023, guess what you're going to do again? You're going to then be thinking about your Q2 2023 and what needs to be true in order to get up to that level. So that's the process I go through. I go through it every year. It's a framework that I learned about 2 years ago, maybe 3 years ago, and it works amazingly well. Hope that was helpful. And then let's talk briefly. I've got a couple questions that have shown up. Feel free to ask some more questions if you like. So I've got one question here that was actually emailed to me before. And the question was, let me just look at it again real quick so I don't forget him. It is. Question was, can I place on my business website a reference that I do syndication deals, as well as a prompt to be notified of additional details or future opportunities? No details or specifics. Is it legal and acceptable? The short answer is yes, kind of. What we don't want to do is we don't want to use that as a pretext for saying that you've already got a pre-existing relationship with the investor unless there's been a substantial amount of time. So if you're doing a Rule 506B offering where you need to have that pre-existing relationship and you need to establish that, if you have on the website that exists and somebody were to log in and you immediately call them and immediately place them within that week, I don't think you've done that long. If, however, you put on the website, I do syndication deals, this is what my fit looks like, there's a great chance to talk about your fit and talk about your overall mission and what your company looks like and what you provide. And then you start that conversation, and the time period is maybe a month between when they've made that contact and when you talk about any other specific deal. You've probably made enough of a relationship at that point that there's not going to be a problem. The SEC has hinted at a month being sufficient. They haven't outright said that it's sufficient or not sufficient, but certainly a month probably is. Probably a little bit less is sufficient as well, but it all depends on what that intake process is. So I would say, yes, do it, but make sure there's enough time gap between when they first contact you and when you talk about any deal that you're working on. All right, are there any other questions that are coming up? Nope. I think I've given you a huge fire hydrant of things, and I hope this was helpful. Okay, great. We've got one. Okay, perfect. I'm glad that you that this was helpful for you. You can certainly do that. You can certainly do what you're talking about there. You're asking about a fund for unaccredited investors for new development. Absolutely. So you would be doing an offering through under Rule 506B. I would suggest you'd probably want to be thinking about it in terms of a uh, doing a putting together a closed-ended fund, so over a shorter period of time or over a defined period of time. So you'd be raising money over the next, say, 6 months or so. You'd have this window of deployment, and then you would be going from there. Okay, you're asking, yeah, B or you mean B or C? So you would be doing it under 506B if you were going to be doing non-accredited investors. You would not be able to do general solicitation. But again, I would probably encourage you to do it as a closed-ended fund. That way you can then, it's just simpler in general. You can think of an open-ended fund as like how a mutual fund works, and a closed-ended fund is more has a specific time period set to it with a specific exit. Doesn't matter if you don't actually hit that time period, just matters that that's the plan, and then you're sticking with the plan that you told them. So there, you may need to make decisions like sell the properties earlier or later, depending on market conditions. But that's there. And no, you don't need to have a cap on the money specifically, but I think that it's more difficult to raise funds if you're not telling people exactly what that, how much money you're looking to raise is. So investors generally like to know what it looks like. We can sometimes make it a little bit more amorphous and not have a very specific dollar amount, but it is, you're better off because ultimately an investor is buying a percentage of an LLC. They should, you should have some sort of idea in there, and then generally we'll shift it up a little bit. So if that number was say 10 million, you may put it out for 11 million or 12 million just to give yourself a little bit of buffer. And then we can always figure out how to adjust it later. So hope that helps. Looks like it did. Good. Glad. And if I don't see any other questions, we will close this out. I hope you found this helpful. And then we are going to be done doing webinars until next year. I'm sure we'll be putting on something in January. Again, if you want to get started with putting together a syndication and you need help with the documents or anything along that lines, make sure to give us a call. We can set up a meeting, make sure there's a good fit. If I haven't worked with you before, we can see if there's a good fit. If I have worked with you before, there probably is a good fit. Or if you're already an existing client, please don't hesitate to let me know if you want to meet, talk about whatever it is that you're working on, any questions that you have. Again, once you're a client, my phone lines are open, or meeting Zoom's open. We can definitely talk about whatever it is that will help make you successful. So with that, I'm going to close this meeting out, and I wish you a very happy holidays, Merry Christmas, happy Hanukkah, whatever holiday you may celebrate, and a wonderful New Year. And we will talk in the new year.